Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Sentiment Analysis in Trading, how it's shaping modern financial strategies. Algorithms and tools in sentiment analysis. Once the data is collected, it needs to be processed. This is where algorithms come into play. Advanced sentiment analysis relies on a mix of machine learning, ML, and natural language processing, NLP, techniques to extract insights from language. Here's a breakdown of the tools and methods involved. Sentiment classification models. These algorithms categorize text as positive, negative, or neutral. Some even assign a numerical score to reflect the strength of the sentiment. Popular models include support vector machines, SVM, and deep learning-based systems like BERT, bidirectional encoder representations from transformers. Natural language processing. NLP tools analyze the structure and content of text to understand meaning and context. This is crucial when parsing complex sentences often found in financial news or reports. Software platforms. Tools like Python libraries, e.g., NLTK, TextBlob, or Spacey, and sentiment platforms, e.g., Lexalytics, Finviz, make it easier to turn raw data into actionable insights. Entity recognition. Algorithms identify key subjects like company names, ticker symbols, or sectors to ensure sentiment is tied to relevant assets. Event detection. Tools detect keywords signaling major events, e.g., earnings call, or lawsuit settled, that can trigger sentiment shifts. Backtesting frameworks. Traders often verify these algorithms by applying them to historical data, checking whether the sentiment insights would have predicted past price movements. These systems work together like gears in a clock, efficiently processing unstructured text and revealing patterns hidden in massive datasets. Real-time versus historical sentiment analysis. When it comes to trading, timing matters. Sentiment analysis can either focus on real-time data streams or historical trends, and each approach serves a distinct purpose. Real-time sentiment analysis. This method is all about speed. It monitors the constant flow of news, tweets, and updates, looking for immediate changes in sentiment. Why is this crucial? Markets move incredibly fast. By analyzing sentiment in real time, traders can react to breaking news, like a CEO resignation or a surprise earnings beat, before prices adjust. It's like being the first in line at a sale. Early access can make all the difference. Common tools for real-time sentiment include APIs from platforms like Twitter or news aggregators fueled by AI models designed for rapid processing. Historical sentiment analysis. While real-time data is about the now, historical analysis offers context. By studying how sentiment shifted in the past, traders can uncover patterns and trends. For instance, how did markets respond to similar news in the past? Was a spike in negative sentiment typically followed by a price drop? Historical sentiment data is immensely valuable for long-term planning. It's used for backtesting trading strategies and fine-tuning algorithms. Think of it as reviewing game film before the next match. It helps refine tactics and anticipate future scenarios. Both real-time and historical analyses are like two halves of the same coin. Real-time data gives you agility, while historical data provides depth. Together, they create a comprehensive framework for understanding and leveraging sentiment in the markets. By integrating diverse data sources with powerful algorithms and a blend of real-time and historical insights, sentiment analysis equips traders with a competitive edge in an arena that often feels unpredictable. Applications of sentiment analysis in trading. Sentiment analysis isn't just theoretical in trading. It's a practical tool that traders and investors are increasingly using to gain an edge. By capturing how markets feel, it informs decisions and strategies that go beyond traditional analytics. From predicting trends to managing risks, here's how sentiment analysis is transforming the trading world. Predicting stock market trends. Understanding the stock market often feels like trying to predict the weather. It's influenced by so many factors, and sentiment is one of the big ones. Sentiment analysis helps traders forecast stock price movements by examining how the public, news outlets, and analysts are reacting to events in real time. For example, when a company announces a new product, investors might turn to social media to measure the buzz. Are the tweets and discussions overwhelmingly positive? That could signal a rise in the stock's value as excitement builds. On the other hand, negative press or outrage on forums can indicate potential trouble ahead. Why does this work? Markets react quickly to perceptions. A wave of enthusiasm can lead to increased buying activity, while fear or skepticism can trigger sell-offs. Sentiment analysis allows traders to spot these emotional triggers before they fully materialize in price movements. Key ways sentiment can predict trends include capturing news sentiment. Major headlines can move markets. Sentiment tools analyze tone to determine if news coverage is likely to trigger buying or selling activity. Tracking social media chatter. Platforms like Twitter often act as early warning systems for changes in sentiment about specific stocks. Analyzing earnings call language. Positive or cautious phrasing in quarterly updates can tilt sentiment, driving short-term fluctuations. By quantifying these emotional signals, traders gain insight into how markets might behave before technical indicators catch up. Essentially, it's like catching the wave just as it begins to crest. Cryptocurrency trading and sentiment analysis. Cryptocurrency markets are notoriously volatile, driven less by fundamentals and more by speculation and sentiment. In this space, sentiment analysis isn't just helpful, it's essential. Unlike traditional stocks, cryptocurrencies are heavily influenced by real-time conversations on platforms like Twitter, Reddit, and Discord. One meme or tweet can send a coin soaring or crashing. Take Bitcoin, for instance. When a major influencer or CEO tweets about it, sentiment around Bitcoin can flip instantly. Positive mentions often spark buying frenzies, while fear-inducing statements can result in sharp sell-offs. The same applies to altcoins, which often experience even wilder sentiment swings. Sentiment analysis shines in the crypto world because it captures these rapid shifts faster than traditional methods. Tools draw from social media feeds. Monitoring hashtags, mentions, and discussions can reveal market sentiment before a move occurs. News headlines. Cryptocurrencies are sensitive to regulatory news, partnerships, and technological updates. The tone of these reports can tip off traders about where a coin might be headed. Community forums. Platforms like Reddit provide unfiltered discussions that can shape retail investor behavior. Why does this matter? In a market that never sleeps, traders need to act fast. Sentiment analysis provides an edge by identifying opportunities and risks faster than price charts alone. With crypto, ignoring sentiment means risking being caught off guard by the next big swing. Risk management strategies. Trading isn't just about chasing profits, it's also about minimizing losses. Sentiment analysis can play a critical role in managing risks and building a more resilient portfolio. By understanding the emotional currents in the market, traders can adjust their strategies to avoid unnecessary exposure. For instance, when sentiment data shows rising negativity around a particular sector or company, it may be an early warning to reduce position sizes or hedge investments. This is especially useful in preventing overconfidence during periods of market euphoria, which can lead to reckless decisions. Here are a few ways sentiment aids in risk management. Identifying overhyped assets. When sentiment reaches extreme highs, it often signals that a market correction is on the horizon. Traders can use this as a cue to sell or short certain assets. Navigating market crashes. In times of panic, sentiment analysis helps traders stay calm by providing data-driven insights. Instead of reacting to fear, they can make decisions based on objective sentiment metrics. Balancing portfolios. By tracking sentiment across multiple sectors or asset classes, traders can build a more diversified portfolio. For example, if sentiment toward tech stocks is shaky, it might be wise to allocate more to defensive sectors. Think of sentiment analysis as a compass in stormy waters. It doesn't eliminate risk entirely, but it keeps traders from being caught in dangerous currents without a plan. Instead of reacting emotionally, they can rely on data to make informed, balanced decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.